Okay. All right, so let's continue with question 13 here. So it says prepare contribution format segmented income statement that includes a total column and columns for the east and west regions. Now again, if you remember, they gave us the number of items sold in each one of the regions. So I'm just simply going to take the units sold times, and again, I'm going to jump back up here and grab that unit selling price. And if I do an F2, the thing that B5 needs to get a little F4 action on it to lock that in. So then you should be able to do a copy and paste on that one. To get you to the correct answer. Okay. Then, again, we're doing our variable expenses. Now, just keep in mind, though, and this is where I kept looking at this one and I kept thinking, they changed something. What did they change? Because if you don't perceive what they changed, this one's going to give you a little bit of difficulty. Do you see it? Good. In that variable expense area, they grouped the cost of goods sold and the variable selling and administrative expenses in there. So that one can give you a little bit of a difficulty if you're not paying attention. So again, we need the number of units sold, but we've got to pick up the total variable cost, which then at this point is actually that number right there that I gave you a little total on. Every other time they have broken that out into two line items. One says cost of goods sold and one says variable selling and administrative expenses, but this one they do not. All right, so then again I'm going to do a little F2, and on that C17 I'm going to give that one a little F4 action to lock that one into place as well. So then I'm going to copy. I'm not dragging and dropping because there's a space, a column in between there. Okay, how are we doing? Okay, then they asked for the, remember now we're dealing with segments. So they've got traceable fixed expenses. So if you remember, that came from, let's see, wait a minute, the first one, let's see, make sure which region I'm in. I'm in East Region. So the traceable fixed expenses for East Region were that one, because that's the only thing that they gave us that was traceable. Then they gave us the West Region. That was that one. And then that 66,000 is going to be those common fixed expenses. All right. Plus, oh, hang on. Let's not forget, we've got some additional items going on there. So I'm going to get a little F2. So remember that that is the traceable fixed selling and administrative expenses. And then we also need that fixed manufacturing. So don't lose your context here on this one just because they added segment reporting to it, but this is still a contribution margin income statement. They're just breaking it out by segment. Now, I will tell you, one of the things that that they did talk about it was in, I think he talked about it in the recorded lecture, which I thought was very good. But the one thing that he brought up was this whole concept of managers, when you actually allocate costs to their division that they can't control. And let me just tell you, that gets really upsetting for people. And he talked about the fact that it's like when you're talking about these common fixed costs, those are costs that would continue to be incurred period after period after period, regardless of whether we shut down one or both of those divisions. Okay? So make sure, that's kind of one of those things to be thinking about, because one of the other things that we can do internally as accountants is help management figure out how compensation plans should work. And when you are compensating division managers on division profit, and then you're allocating costs that they can't control, and then basing their pay on effectively their net income for their segment, they don't like that so much. Okay? So again, some of the things that we do as accountants. All right, let's take a look at this next one. So the next one says Diego is considering eliminating the West region because an internally generated report suggests the region's total gross margin in the first year of operations was $50,000 less than its traceable fixed selling and administrative expenses. So again, think about what they're saying there. The gross margin was $50,000 less than the fixed expenses. So on some level, if the region's total gross margin, right, we're talking about this number right here, right, was $50,000 less than its traceable fixed administrative expenses, we might be showing a loss in that region. So then we've got, Diego believes that if it drops the West region, the East region sales will grow by 5% in year 2. Using the contribution approach for analyzing segment profitability and assuming all else remains constant in year 2, what would be the profit impact of dropping the West region in year 2? Okay, so again, we've got 0 here, right? So 0 would be the sales. We wouldn't have any fixed expenses, and we wouldn't have any traceable expenses to actually send to that region, right? So the only thing that we would have is the East region, okay? So now this and let me say it this way. This 34,650, right? We originally had the 33,000 in sales, so this 34,650 is already adding the 5%. So maybe I highlight these and give that a little highlight. Maybe that would help better. Okay? So this is a new calculation on the total. So again, when we're dealing with sales, it's just simply sales, number of units sold, times that $77 per unit. That hasn't changed. Our variable expenses, now again, remember on this one, that is going to be total variable expenses on this one, and that is going to be the $47 per unit. And then we've got the traceable fixed expenses, and I think we're staying at the 170. Okay? So right now, this is what the East region is looking like. But now, we've got that common fixed expenses. They only drop in that same $930,000, and we end up with their interpretation is the loss of $650. Now, I would say this is a slightly incomplete analysis because, again, remember, these traced fixed expenses, those may or may not be able to go away immediately. That's kind of the reason why they're called fixed expenses. Okay, so I got a little bit of a beef here with him with the author on this particular solution. Okay, so the foregone segment margin in the West region is that 80,000. That's this number right here that we just calculated on the previous question. Okay, the additional segment margin in the East region is simply the 689.5 minus the 820. Okay, so the impact on net income is a reduction of $30,500. So, should we get rid of the West region? I wouldn't. Now, what might work better in this one is if we think that we want to get rid of the West region, because again, notice, again, you got to step away from it, big picture view. Remember that the unit sales for the East region and the West region, right? The East region is selling many more units, right, than the West region. But on some level, until we can get a plan together to really increase those unit sales much higher, not 5%, but more like 30% in the East region, then we might just need to keep the West region. So even though they're not doing much compared to the East region, they're contributing a little bit, okay? And a little bit is better than nothing. So again, if you start to notice, it's like we're taking numbers. That whole thing of it's like we're telling stories, but we're just doing it with numbers. So there's a lot of interpretation and everything else that's got to go on there. All right, let's look at number 15. Assume the West region invests $38,000 in a new advertising campaign in year 2 that increases its unit sales by 20%. If all else remains constant, what would be the profit impact of pursuing the advertising campaign? So this group right here, right, I'm just coming back up here and I'm just pulling this information right there, right? That was the existing information. Okay, we're told that the unit sales would increase by 20%, so we're just simply going to take the 10,000 times 1.2. That drops in our sales, because that's just simply 12,000 times the 77, and then 12,000 times the total variable expenses. Okay, and then on this traceable fixed expense, you can come back up here. Whoop, hang on. The traceable fixed expense, right, is, well, actually, let's do it this way, is the 220 plus the 38,000. So at that point, we've got a new margin income of a 102, which means that now we've got an increase in that particular segment's gross margin of $22,000. So, should we make the investment in the new advertising campaign? Yes. Now again, this is one of those things where if you're reading the book, I gotta tell you, this is probably one of the better textbooks that I've seen. This guy does a really great job of giving you examples of things that are real world that you should be able to relate to. Now, one of the examples that he gives in a situation like this is J.C. Penney. Okay? Now, at this point, I'm trying to think, JCPenney has been in trouble for years and years and years, and I'm trying to remember at this point, they may have actually already declared bankruptcy. I can't remember. But JCPenney, for a number of years, it was kind of one of those things where you knew that Christmas was coming when you got the JCPenney catalog. So you got to kind of, in context, again, I always tell you all this, context matters. So everybody, loved the JCPenney catalog. You just, you got the JCPenney catalog and you just dug through it and figured out what you wanted to do. Well, one of the interesting things about JCPenney was in a certain area, they give you the example, that they actually stopped the JCPenney catalog in a certain area and went with all online advertising for their next campaign. The interesting thing is that even though, probably for some other company that may have actually worked well, for JCPenney, they actually saw a decline. And they actually reinstituted the catalog in that particular area because that was a better dollar for dollar return, sales return on their investment. So read don't just read in the white space, right? All those little examples and everything in those little boxes and everything else are actually really great little examples. All right, so there is sort of a run through of the whole entire chapter. Okay. Let's do one more question. Okay. So let's look at exercise 1-6. All right, so in exercise 1-6, we'll finish on an easy one. All right, we've got Ida Company produces a handcrafted musical instrument called a gamelan that is similar to a xylophone. Now, does everybody understand a xylophone? Right? Looks like a piano, but it's effectively bells. Right? The gamelans are sold for $808. Selected data for the company's operations last year are as follows. Okay, now again, when we're looking at some of these things, don't blow over some of the data. Understand what's there. So in this one, I think they actually gave you the beginning inventory was 0. They gave you the number of units produced, units sold, and ending inventory. I don't think I did actually calculate ending inventory. Now again, so stop and think about some of these kinds of things when you're going into a problem like this. So we've got, we produced more than we sold. So again, when we're thinking about the differences between variable costing and that full absorption costing, remember that full absorption costing, we moved some of that expense over there into ending inventory, right? And now we've got a difference between variable costing and that full absorption costing. Okay. Then they gave us the variable cost per unit. Okay. I gave you the little total variable cost per unit. Then we've got the fixed manufacturing overhead and the fixed selling and administrative expenses. So again, notice what's happening there. We're getting the same data just like that last problem in the foundational problem. And we've just got to, again, start answering some of the questions about what is going on here. So it says assume the company uses absorption costing. So now, again, think fixed manufacturing overhead is going into the cost of that product. So we're still picking up the direct materials, labor, and the variable manufacturing overhead. So materials, labor, variable manufacturing overhead. And now we've got this fixed manufacturing overhead number where we've got the fixed overhead divided by the total number of units produced is going to give us $678. Oh, there you go. Okay. All right, so we're getting cost of $678 per unit. All right, when we're using that variable costing system, all we're doing is we're picking up the materials, labor, and that variable manufacturing overhead for cost of goods sold. So again, don't grab hold of that variable selling and administrative expense when they ask you about product cost. Okay, so that's one that's, pretty easy to do. I think 6.2 is also one that functions basically the same way. They're giving you all the information just like we've seen before, but again, sometimes I'm adding things in there because again, I want you to see that in this particular case, we had 0 units in beginning inventory. We had 30 units in ending inventory. That means we put more units into ending inventory. Ending inventory went up, which means we're going to have that variation between that full absorption costing and that variable costing because of that fixed manufacturing overhead number. Okay. Now in this one, let's see, this is the same one. This one, they ask you for a little bit more information. So it says, what is the unit product cost under absorption costing? And then they also want to know, so how much fixed manufacturing overhead cost is included in the company's inventory at the end of last year. Okay, so again, let's go ahead, and this is a good one. I like this one. Here's your direct materials. We've got the labor and the variable manufacturing overhead. We've got to calculate that fixed manufacturing overhead. So we're going to grab that divided by the total number of units produced. So we've got $725 per unit in this one. Okay. The units that are in ending inventory, right, were 30. And they want that manufacturing overhead cost that is in ending inventory. So it's just simply the 30 units times that fixed manufacturing overhead cost right there, or $7,500. I'm hoping I'm making this clear for you on this reconciliation piece of that. All right. Then they ask you to prepare an income statement for last year using variable costing. Well, so let's pick up number of units sold times the sales price per unit. We've got and again, now in this particular question, notice how they went away from total variable cost to the variable cost of goods sold and the variable selling and administrative expense. So again, don't miss that one. That could be one of those where it's like that would mess you up. So we're going to pick up the total number of units sold, and we need the total product cost. Now, watch this one. So I did a times, and I'm going to do a sum. You haven't seen this one yet, of these 3 numbers right there. So notice how I did that one. So that's a slightly different way. So there's our total number of units sold times the sum of those 3 variable costs. Then our variable selling and administrative, we've got our units sold, times our variable selling and administrative. Then we've got our fixed manufacturing overhead. We come up here and our fixed manufacturing overhead gets dropped in. And then our fixed selling and administrative, that's this one. So in this one, we got net operating income of $1,400. So the biggest thing here is just, again, the one thing that I think is probably the most difficult in this one is just this little piece right here of how much of that manufacturing overhead cost is sitting in ending inventory. We'll look at another one of those in the next class. All right. How we doing? Okay. The next ones that we have, they're basically the same, so you might want to test out a few of these. Not anything different because, again, that's still learning objectives 6.1 and 6.2. And then when we get to exercise 6-3, we'll probably pick up from this one from here on out. Or in the next class. This is the one that's got that 3 years worth of inventory variations, and we're putting inventory in, we're taking inventory out. How is that net income changing? And that one is going to take a whole lot longer to do than we really have time left to. All right. All good? Okay. All right. Let's see. Let's take a look at the schedule here real quick. All right. So the good thing is that between now and Monday, you actually don't really have anything due over the weekend or anything, so a little bit of a breather. But you do have your Chapter 6 homework due. So I would go ahead and open up that Chapter 6 homework, knock out a couple of questions and see what you can do there. The other thing that you need to be working on, just to kind of give you that comprehensive problem progression point, is that come Monday, your question 1, requirements 4 and 5 should really be complete. So at this point, come Monday, you should have question 3 completely done. Okay, don't wait on that one if you have not done anything on that, because the first question is chapters 3, 6, and 7. Okay, so we've gone through all 3 of those. So get to a point where it's like you can have a little bit of a breather. It's also a really good example for the unit exam, because believe it or not, we got an exam again next week. All right, so next week the exam opens on Tuesday, and I believe I have already set it to close, even though I got it on the schedule for Saturday the 23rd. I've got it set for Sunday, November 24th. Now, that feels weird. So, remember, because of November 1st was like Friday, remember that Thanksgiving is like a week later this year than normal. So, Thanksgiving's like the 28th or something? Really odd like that. So don't get your schedule messed up in your head. So we haven't forgot about Thanksgiving, because you flip the next week, and then Thanksgiving, it's the 28th. So we'll get a little bit of a break there. I tried not to have anything open or due like right after Thanksgiving. Over Thanksgiving. Let me say it that way. Over Thanksgiving. So we will finish up. The last day of class is Monday, December 9th, and it is coming quickly. Okay? So we'll have one more exam. Just remember one other thing. I just want to keep reiterating it. On that last exam, I removed, in the comprehensive problem, there is a very large question on Chapter 8 in that comprehensive problem. So I removed anything from Chapter 8 in the 4th exam in the problems area, because I just don't think there's any reason to just beat you with it. So just keep that in mind if you need to make a note somewhere. All right? All good? Okay. Have a great weekend.